Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. Welcome to Charts of the Week for August 23rd of 2021. Please see our disclaimer for important information. Well, as we get started this week, a quick programming note that I will be out of town next week, so we will not have either Charts of the Week or Market Minutes for the week just preceding Labor Day, but we should pick up again right after that. So as we get started with the news you can use here, here's the COVID tracker that we've kind of resurrected here for the time being because of the rise of the Delta virus. You can see as you track over to the far right, so this wave of new infections seems to have crested. Now we want to make sure that this is not just kind of a false peak, if you will, and there's going to be another kind of a resurgence, if you will, that sends a new peak higher. But it does look like that we are cresting here at this current wave, both in terms of the infection rates as well as the 7-day moving average for daily deaths. We will continue to post this from this data from First Trust that are now getting again once a week until we see a kind of a definitive rolling over in the case volume for the Delta variant. Here's a quick look at our weekly high frequency data, again published by our friends at First Trust up in Chicago. You can see the impact of Delta on several variables here, and it actually extends into rail car traffic and steel production, which is a little interesting. We do see production levels beginning to roll over. Now we know that manufacturing was at a fever's pitch for a while, and we've had some supply chain choke points, and we've also had a rise in some of the commodity input prices, as we've talked about ad nauseum over the last several months. And I think what we're seeing is finally beginning to witness the manufacturing rates beginning to kind of flatten out a little bit. Again, they're not dropping precipitously per se, they're just kind of slowing down. And then if you get down towards the bottom half of this chart, you can see some of the more consumer-focused variables, TSA checkpoint data, commercial flights, hotel occupancy, and open table restaurant information. We are getting back to school, so that does have something to do with it, but we do see the impact and have for a couple weeks now from the Delta variant. Here's a quick look at freight rates and the Baltic Dry Index, which very bellwether indicators of shipping activity and also shipping prices. And what we see here is, I mean, we have seen shipping rates, freight rates, and these are containers, basically, cross ocean container ships and freight rates for those that are exceptionally high, and they are off their peaks a little bit for most categories, especially China inbound to North America. Northern Europe seems to be continuing to move a little bit higher. And then if we look at the Baltic Dry Index, that's extremely high. I mean, we haven't seen these levels in a long time. So obviously shipping is very costly, and these types of costs manifest themselves if you had a child that needed back to school clothing, that you would definitely have felt that in the pocketbook, because a lot of the apparel manufactured comes from China, and so those costs are definitely embedded in what you're paying at the retailer. Here is a quick look at rail car traffic, and you can see, we were tracking really on top of 2019, and that's kind of tailed off a little bit. And nothing that gives me a tremendous amount of worry right now. It's just it's finding what that mean or average is now. It's kind of finding that new post-COVID average, as we have essentially recovered a lot in freight, in rail car traffic. We know that there's a lot of products moving back and forth, and we even see it in less than truckload data. But again, it's just not as high as it was, and certainly not tracking where we were in 2019. And you can see on steel production, we have caught up. So, I mean, these two categories here on high frequency have really been strong stories to talk about over the last 6 to 12 months, and they're just kind of flattening out a little bit right now. As we start looking into some of these various data points, here's a quick look at the global economic surprise index and economic data summary basket. And the one on the left is a little bit noisy, got a lot of colors embedded in it, but basically you look at these two and you say, all right, the positive surprises that we saw post-pandemic are kind of going away. There's a lot of there's a lot of negative surprises, obviously, at the beginning, and a lot of positive surprises that came on the heels of that as we really have this whipsaw recovery. And now we're just kind of, again, like I've said in the last couple slides, just kind of flattening out. There's not a lot of surprise out there. I think everyone's expecting 2022 to be, a little bit more subdued in terms of activity than 2021. We kind of feel that in the data already. We see that maybe we've hit peak growth for this particular cycle, but again, as I've said many, many times, there is a high probability of a long cycle evolving, even though you might have hit peak growth. And it certainly seems to be the case when you look at the economic surprise index from Citigroup. And then on the left-hand side, it's just a visualization of the economic data that was intensely positive earlier this year. And this is global data. So, but it's just kind of flattening out and kind of rolling into that long-term average. Here's a look at the Conference Board index of leading economic indicators. And on the left-hand side are kind of two representations of that. You can see essentially the month-over-month data, which continues to be positive. Frankly, we haven't seen a negative data point in the leading economic indicator index basket. And you can see on the bottom hand where we've kind of gotten close to that pre-COVID trend line. We're not quite there yet, but we're certainly moving higher. And the LEI has been fantastic post-COVID. And you can see on the right-hand side, it's the contributors to the LEI. And what's really profound in this latest data point is that all of the 10 major indicators are positive. So just a little bit of education here. So, credit is really strong right now. Manufacturing new orders, even though we've seen a little bit of rolling over in manufacturing activity, new orders are really high, non-defense. Consumer orders are high. Labor is looking good. Average work weeks are extending because it's hard to find labor. We are seeing higher costs as a result of that, but consumer expectations might be rolling over a little bit because of Delta, but they're still positive and still contributor. And then on the interest rate side, the spread is still positive, even though the interest rate, the yield curve is flattening, and we're seeing a little bit of rate spread or term spread on interest rates. And then obviously the stock price indicator, or at least a component that's tied to the S&P 500, has been positive. So all in all, a good report from domestic leading economic indicators. The quick check-in on labor here. We've got the change in non-farm payrolls. This is, I thought, was a really interesting representation because it literally gives you the numbers sequentially, month over month. And you can see we really only had one negative data print at the end of last year, and otherwise, we've had this incremental improvement in the labor market. What's interesting in this cycle, though, is we have participation that has really struggled, and we've seen a decline in labor force participation for essentially decades, and we did see it begin to pick up before the pandemic, and we're trying to recover off of that, but we've had a huge displacement of labor. And then we've talked about the quit rates, we've talked about the difficulty in hiring labor. We've got a slide coming up just after this one on that very topic. But what's interesting here in this recovery, labor force participation is noticeably lower than it used to be. And as I mentioned, here's a quick indicator that we've seen from the National Federation of Independent Business on a Bloomberg chart here. Small business job openings hard to fill. Not too surprisingly, that number is exceptionally high. That kind of light blue line represents kind of an average over many decades. This data series goes back to 1973. So it's pretty telling where we are right now, that this is a very unique situation that we're in now with businesses that are really struggling to find labor in a lot of areas. And on the right-hand side from BKA research is kind of a breakdown in why that is the case. And they've looked at two surveys. One is a business leader survey. And the other one is the Empire State Manufacturing Survey, which is done by the New York Federal Reserve. And the data looks very similar. So obviously a lack of qualified applicants. We talked about the reduction in the labor pool and labor supply in the previous slide. Applicants unwilling to accept compensation levels offered. So compensation is a real issue right now. And so employers are having to spend more to hire, and the competitive marketplace is really intensified. So I think we're very apt to see further labor and wage inflation as a result. Here's the third set of columns here. The candidates rejected job offers for other reasons, and this is, it can be due, and we've seen a big drop off in women from the labor force, and a lot of that has to do with child care, lack thereof, school at home. There's a lot of different reasons there. And then candidates rejected job offers due to coronavirus-related health concerns. So there's a health component that's kind of peeking its head up there. But in any case, you can see that there are multiple reasons why labor is hard to find right now, aside from the fact that pure and simple that we've had labor participation go down. Quick check-in here on inflation. This is kind of a sequential look, and I thought that this was a really good chart to show on the left-hand side. So this is core personal consumption expenditures inflation. This is what the Fed pays attention to, as we've kind of talked about. And obviously, we're kind of peaking right here at an interim level, 3.5%. We've seen relatively high data points the last several months. We do expect that to roll over and then kind of wind up in maybe a 2 to 2.5% level perhaps next year. But you can see that we've been in a really strong secular decline in inflation dating back to basically what I'll call the Paul Volcker Federal Reserve, which was back in the early 80s when we had ultra high interest rates, ultra high inflation, as you can well see there, and raised interest rates dramatically to try to fight that. And ever since then, we've seen this secular decline in inflation, and it's real interesting to see these latest data points perk up so much relative to that longer term trend. And then as you look at the right-hand side, this is a 10-year break even. So this is basically taking the 10-year Treasury and the difference between that and the yield on the Treasury inflation protected security, or TIP, for the 10-year maturity. And this is the difference that's being implied by that. So the yield difference is essentially 2.4. As you can see here, going back to 2000, it's been right at 2% or 1.98% here. So we are above the long-term average, and we've kind of certainly understood that here over these many months. But it does tend to mean revert. And again, I think more power to to the argument that we're going to have inflation roll over, but it's going to sit at a level that's higher than this 1.98 here over the next couple of years, perhaps. Gasoline prices. This is very important to consumer sentiment, important to consumer behavior, because this is something that is almost, inelastic. I mean, we travel, you can modify your driving habits if gasoline prices are really, really high, but people have to get to work if they're not taking public transportation. We've got to go get groceries, and even though there is more of a gig economy where people are delivering to us, but you can still see that well, you still know that gasoline prices are important, and right now the national average is about $3.19. This is a 7-year high, so this is important for us to monitor in the weeks to come. Certainly reflective of on the backdrop of higher overall crude prices, which will obviously feed into this. Here's a quick look at the dollar index, US dollar. What we see here on the left-hand side is a data series going back to 1967. So we've got a lot of history here and a lot of amplitude, high and low. The average of the index, of the DXY index, and you can look this up. It has a quote to it, so you can go look it up basically. And it's just under 97. That's the long-term average, and we're about 92.25 right now. So we have weakened up a little bit. A weak dollar does help commodities. It certainly helps emerging markets. A weak dollar makes U.S. production more attractive to overseas buyers because it is cheaper in relative terms. And if we slide over to the right, what we're looking at here is a little bit more of a near-term view. And what you can see is that we have, on the heels of this kind of like multi-year decline in the dollar, if you will, we've actually had a perking up of sorts dating back to the May-June timeframe. And this seems to indicate, or seems to suggest that we're going to have higher interest rates in the future with this kind of a move that we've seen here to date. Here's crude oil. We were just talking about gasoline prices, and you can see on the left-hand side, after the big dip due to the demand for crude falling off the cliff in the pandemic, we've seen a strong recovery. And you can see that crude oil, West Texas Intermediate or WTI, is exceptionally strong, and I think is apt to stay there. We've seen, a lot of the traditional political jockeying by the OPEC Plus group to, either impose production curbs to keep prices high, and oftentimes you have members cheat on that. But there seems to be the backdrop, or at least the makings of a higher price regime in crude price. On the right-hand side, you can see that rig counts, noted here in blue, have picked up, but they are exceptionally low relative to where they were. They're really back to 2016 levels, but you can see here in these peaks that we've had much higher rig counts than we have right now, and there's still a little reluctance on the part of drillers, especially the marginally financed drillers, to reopen those wells. I think there's a general maybe a concern over the future financial condition. There's a concern over availability of credit, even though credit has become a little bit more abundant. So this is a little stubbornly low at a time where we see oil production kind of flatlining at this level below the prior pre-pandemic peak. So we'll obviously continue to monitor this, and you would expect crude prices to perhaps moderate a little bit if you saw rig counts move markedly higher and you saw production move markedly higher. But so far we're just not seeing it, and there doesn't seem to be a lot of visibility to having that rig count and production number move significantly higher anytime over the near term. This is a quick check on another of the regional surveys that we get. We've shown you the Richmond Fed, we've shown you the New York Fed, this is the Philly Federal Reserve Index, we've shown you the Kansas City Fed. I mean, all of these Federal Reserve districts have these types of surveys, and this is just the latest one in the series that I think it's portable feedback. It gives us, what I mean by that is it gives us a view into what's going on just in general. And what we're seeing in manufacturing here is that we've been at a fever's pitch in manufacturing to help support the high demand that came out of the pandemic, frankly the unexpected demand. And now we've seen that kind of peel off a little bit, although capacity utilization nationwide is kind of almost recovered its lost ground. So utilization as a percent of total capacity is actually really close to pre-pandemic levels. But right here we see that we've just had a little bit of slower growth in manufacturing, even though on the right-hand side you can still see that new orders are pretty strong. So I think this certainly sets the stage for continued pricing power for manufacturers. I think this probably is representative on the left here of some of the supply chain choke points that still persist, especially in semiconductors, which that component problem could persist well into 2022. But again, nothing to be alarmed about here. We're just kind of slipping into this new normal in terms of manufacturing utilization and new orders for an economy that's continuing to expand. And now for a quick check on credit, we've got mortgage delinquencies as a percent of total loans. We've got foreclosures as a percent of total loans. And what you're seeing here is actually a really strong environment. Last year at this time, we were still kind of concerned that we were going to see a credit problem. We're going to see a fairly strong rise in delinquencies, which we actually did, but it ended rather quickly after the pandemic. And then we've continuously seen that drop as a percent of total loans ever since. So, we thought that number might continue to go higher. We thought we might, reattain the prior peak that we saw in the aftermath of the global financial crisis. That clearly has not happened. And if you look at foreclosures on the right-hand side, you didn't see a spike because we had forbearances in place. And so even though you had a rise in delinquencies, you just didn't have the foreclosure problem. Again, these are positive developments, certainly not necessarily what we thought would play out last year, but foreclosures not spiking was clearly a result of some policies both at the federal and local level to try to forestall a lot of this type of activity. But good data overall. Now we'll turn our attention to retail sales, and what we see here on the left-hand side, we've got a couple of data points, and then we'll kind of end it with a discussion of the control group as a whole. But we see retail and food services month over month become a little bit more choppy. We did have a negative print. We were expecting it to be negative, but it came in a little bit worse than expected. Again, I think it had a lot to do with concerns over the Delta variant, and that's not terribly surprising if you paid attention to the first slide, and we showed you the rise in case volume, and certainly the rhetoric has increased, and so not terribly surprising there. Also on automobile sales, for perhaps some different reasons, we see that rolling over, and so that's not as robust. A lot of that has to do with production capability and choke points. We've got more demand for vehicles coming out of the rental space, which liquidated a lot of inventory during the pandemic, and now they're struggling to restock their own inventories. And we've got supply chain choke points. We talked about semiconductors. That's a problem for the auto industry as well. So slightly negative data here in these categories. But like I said, if you go over to the right-hand side and you look at this control group, which is really a basket where that they're tracking retail sales numbers, you can see that even though it's kind of flattened out a little bit, it's not rising anymore. It's not bad, so we can absorb a little bit of softening here in retail sales. It gives me some comfort to know that we can kind of continue to plow through this despite the Delta wave. And and if you are under the assumption that Delta is beginning to crest, then perhaps in the next couple of months will be rolling over, then our retail sales numbers are actually relatively comforting. And that's important because consumption is a big part of the economy, very big part of the economy. And it's actually very important to the global economy as well. Here's a quick look on the housing market, and I don't know that any of this is going to be terribly surprising, but let's just kind of cycle through these four charts here, and we've got the University of Michigan buying conditions for houses. We know that that's continued to erode over the last several months. Prices are high. We've seen a dramatic drop in the amount of available inventory on the market, which the inventory itself seems to be moderating in certain areas of the U.S. Not widespread yet, but overall these buying conditions. And this is a survey, so it's surveying people on their sentiment. And obviously the sentiment right now is pretty poor if you're trying to buy a new house, even though mortgage rates are exceptionally low. So, but if you slide over to the right, home builder optimism is pretty strong right now. It's off the peak just because we have we don't have as much inventory coming on the market, and you can kind of see that foreshadowed here in the lower left, where you've got single family building permits, which is in that black line. You can see that rolling over in concert with new home sales. So that's why you've got this data rolling over in terms of number of units, number of permits. So it's not too surprising to look on the right-hand side and see home builder optimism come off of its peaks. But I'll hazard too that if you look at the trend line, again, it's falling kind of back to that trend line from frankly a really high position. So I don't worry about home builder optimism. I know that builders are very motivated to want to continue to put product out there. We've just seen a really strong spike in permits and activity and sales despite the higher prices, and we're just seeing that moderation a little bit. All right, commodities. We're going to talk about commodities. This is the commodity index from Bloomberg on the left-hand side in the black chart there. We kind of broken through resistance, but it's a mixed bag. We saw for months and months, just the entire commodity basket move higher. And if you look at the right-hand side, you can see that, we've actually, to that mixed bag standpoint, we've seen some moderation in the industrial commodities, some, not all, and we've seen some continued increase in some of the soft and agricultural commodities. You can see cotton, wheat, coffee, sugar, all witnessing increases, corn modestly higher, and then offsets being, slightly lower in copper. Certainly iron ore has really dropped off the shelf here lately. Silver, platinum, and obviously crude oil is off a little bit, even though prices are still very high, but it's a mixed bag. So the net of all this is that we've seen the commodity index itself kind of drop below its trend line dating back for about 18 months. And this is a quick check-in on yield spreads. And so there's two components of this. That on the left-hand side represents high yield. And so this is the option adjusted spread, or just call it the yield spread relative to less risky investments, like say the 10-year treasury or the corresponding treasury yield, which is kind of commonly referred to as a risk-free rate. And you can see here that the spreads are beginning to eke out a little bit. We've had serious spread compression, which resulted in high yield bonds doing exceptionally well relative to the bond market. In fact, high yield returns are positive year to date, whereas the traditional indices for fixed income are negative. But we've seen a bit of a reversal dating back now about a month. And interestingly enough, that's also taken place on the Barclays U.S. Aggregate Corporate Average OAS. And so this is not the high yield or the lower credit quality bonds that we're seeing this, but it's also in the high credit worthy bond space. These yields relative to treasuries are beginning to widen out a little bit. Some of this has to do with the fact that the economic data, as we just saw several slides ago, is kind of muting out a little bit. We're not seeing the dramatic surprises that we used to, and we're seeing some data points like retail sales and some of these high frequency indicators just begin to soften up a little bit, with the Delta wave kind of entrenched in our conscience right now. But I think this type of move in spreads is actually really healthy because there really was very little room for these spreads to continue to go down. And it was a highly unusual environment, in terms of how you were pricing risk in the fixed income market. And I think it's just become a little bit more healthy now. And as I was talking about before, we've had a yield curve compression. What does that mean? That you have the difference between short-term yields and long-term yields. Usually that is upward sloping because you have a term premium embedded in that. And so you typically are always going to see higher long-term rates than you have short-term rates, unless that inverts, and then that's usually an indicator of onset of recession. But we've had a steepening yield curve, which is very healthy. It's really reflecting the expectation of continued growth. But we've had that flatten out a little bit for a lot of the reasons that we've already articulated on some of these other indicators, just because the data softened up a little bit. There's a little more speculation as to what growth is really going to look like next year, because the data has been so exceptionally strong this year. And so it's just something that we want to watch here. Again, not terribly concerning, but we've seen the yield curve compress a little bit. And this is the difference between the 5-year Treasury yield and the 30-year Treasury yield. Quick check-in on sentiment. This is the American Association of Individual Investors, and they become a little bit more cautious. We see these numbers rolling over a little bit. They were obviously very high post-pandemic, very bullish, and we've seen the froth come off that. Again, I think that's really healthy because I don't think the market operates nearly as well when you have this almost euphoric level of optimism, and it operates a lot better when you're kind of balanced in your expectations. And you can see on the right-hand side a chart from Bank of America that in that little red dot, it's kind of hard to see unless I were to blow this up, but I wanted to put these two charts on here together to show that optimism from a bull-bear spread has kind of rolled over a little bit at the same time that fund managers are beginning to raise a little bit of cash. And so that red dot on the far right here represents the fact that fund managers are just raising cash in their portfolios just a little bit right now. All right, well, here's a quick look at the upper half of the S&P 500. What I thought was really good about this is that it goes all the way back to 1929. So a very long time. So all you financial planning, aficionados, you can look at this S&P 500 and over a long haul, it's a very strong upward bias. And, but we've had recessions along the way, and we've had a lot of stretches where we've been really optimistic, where we haven't had volatility. And we're in one of those right now. And basically the bottom, these spikes, if you will, represent the number of days where there's been greater than 8% above the 200-day moving average. So got to rephrase that. It's a number of days where the S&P 500 has been greater than 8% over the 200-day moving average, which is a really powerful statement. Now that's showing really, really strong market conditions. And right now, you can see here that we're basically at 198 days on this indicator, which is profound. Certainly looking at a backdrop of, literally almost 100 years of data, it's just exceptionally profound, just how strong this market has been of late. And as we get towards the end of the chart pack this week, we've got kind of a viewpoint of what companies are saying coming out of the second quarter earnings calls that, second quarter earnings have really just kind of completed. And so this is kind of a summary from S&P Market Intelligence, Global Market Intelligence, on what was said in these conference calls. So commodity prices, obviously a very strong threat, as is COVID, inflation, labor shortage, energy prices. I mean, we can see that there's a basket of these things that are kind of weighing on the conscience of corporate America right now. Again, CEOs are really optimistic, but these are the things that they're paying attention to a bit more. Environmental regulations, rising interest rates, and continuing trade wars, and the potential for additional tariffs, which I don't see as much. But clearly, energy, commodity, COVID, inflation, and labor are the key headline risks as perceived by corporate America. This is a fund manager survey, so we're flipping the card a little bit. So we're going from corporate America to what the institutional investors are saying. And so, what keeps them up at night is represented here, and you can see the change from July to August, just this 1 month change where taper tantrum, that's not as much a fear, but it remains a strong fear overall. Inflation is the key issue, although with the curbing and and downturn and some of this near-term data, the specter of inflation is kind of not as high as it was, but it's still pretty high. And again, you see the Delta variant stuck in there, as well as asset bubbles. And what's interesting is in August, we're beginning to see the emergence of China in the risk factors that could cause increased volatility. And as we get towards the end here, we've got a couple of charts that I thought were really interesting. This is a comparison of survey respondents back in 1989 relative to 2019. So if you look over, essentially a 30-year window, how have the average 26 to 39-year-old fared in that time? And so there's been a lot of conversation about, the current generation not being as affluent as the last one. And this is data that comes to us from the survey of consumer finances. And what it tells us is that overall net worth is a little bit better, income's a little bit better, and financial assets are definitely better because you have more retail investors. And just to be clear, the 1989 data is indexed for inflation. So it's giving you kind of as best as can be put forth a apples to apples comparison. One thing that sticks out here is that student debt is a lot higher than it used to be. But overall, the 26 to 39-year-old age cohort is doing a little bit better than they were back in 1989. Live births and deaths. I thought this was really interesting, especially after COVID, and COVID accelerated this trend. Now we know that aging population, your death rate's going to increase, but the corresponding birth rate is kind of flattened out. In fact, it was rolling over, and our replacement rate for population was rolling over long before COVID, and with a corresponding death rate, I mean, we're basically at a point now where we have no population growth. So the secular implications of this are clear. If this trend doesn't revert, if you will, is that we're going to have over time we're going to have a contracting labor force, which is the case in Japan right now. But what I thought was really interesting is how this trend was definitely exacerbated during COVID. And I want to finish on on this slide, which is really telling to me. Certainly as a business owner, I pay attention to this kind of stuff. But what we're seeing is a fairly dramatic rise in ransomware attacks on U.S. Companies. And so ransomware accounted for 30% of all cyber attacks, as reported in the Verizon 2021 data breach report. But you can just see the rise in just the last several years, a dramatic rise of the incidence of this. So thought that was interesting to pass along. Well, that's all we got for this week. Again, we will not have charts of the week next week because I will be out of town. Hope you've enjoyed it. On behalf of the entire team, hope you have a wonderful week, a safe week, and we'll talk to you again soon. Take care. Bye-bye.